After a positive January, February saw a reversal in larger US company returns on the back of uncertainties over the US government's policy agenda, which acted as a headwind to both consumer and corporate sentiment. However, other major growth asset markets made headway. The UK and the European equity market showed a positive trend, as perhaps cheaper valuations do matter when interest rates look to be cut. So starting with the economic picture, inflation data in the US and UK surprised to the upside in January, with headline figures of 3%. It was more worrying in the States, where analysts pointed to a core rate of 3.5%, with autos, food, electricity and insurance all important factors even before tariffs have an effect. Despite the ability for tariffs to increase inflation and the January inflation data, markets remain focused on sentiment and the risk to growth. February saw both business and consumer sentiment weaken. Services activity and small business investment intentions both dropped, while consumer confidence recorded its largest fall since August 2021. At present, the markets are pricing in only 1 to 2 rate cuts by the US Federal Reserve in 2025 versus 3 to 4 cuts in the UK and Europe. It's not surprising that the Federal Reserve is hinting that interest rate declines will be limited, whilst the Bank of England in the UK cut rates in February and hinted at more to come in the coming months. Turning to growth assets, European equities outperformed the US in February as investors factored in the likelihood of a ceasefire in Ukraine, along with a strong performance from financials. In comparison, US equities were hindered by the continued worries over the valuations of the Magnificent Seven technology stocks. Asian equities rose by 1.1% over the month, driven by Chinese stocks, which rose 11.7% in dollar terms. Enthusiasm around AI company DeepSeek continued to support the broader Chinese tech story. Japan was the regional outlier as the yen-sensitive market suffered as the currency appreciated by 2.8% against the dollar. So moving on to factor performance, the positive returns in both European and UK markets reflected in the value factor, which was the best performer over the month. In contrast, both small cap and growth were the relative underperformers, as global small cap stocks delivered negative returns on wider growth concerns. So moving on to defensive assets, all major fixed income sectors delivered positive returns over the month, as falling US yields fed through to the other parts of the market. Strong corporate fundamentals helped investment-grade bonds also over the month. So in summary, investors remain focused on whether high earnings expectations are justified, along with the risk to growth in the US. The rise in European equities highlighted the importance of regional divergence, whilst the positive returns in defensive assets show that bonds can once again protect against equity losses. With US-led uncertainties ahead, investors should remain diversified to protect portfolios against any further volatility in the coming months.